Hi team, Adam Thompson here from My Mortgage. Today I'm talking about an interesting concept, and that is the risk of fixing your home loan. And you might say, hey Adam, no, I fixed my home loan because that's going to take the risk out of it. I know what my rate is. And yep, that's a really good point. But as we've probably seen over the last year or so with rates tumbling down, if you fixed your rate for a long term and things change, there's a big cost if you want to break that. And that is a risk, and we call that basically interest rate envy. If the rates drop, you envy that there are better rates out there and you want to get on them. But there's obviously a cost to you, and that's a risk. So you're locked in and you can't guarantee that you're having the best rate on the day. But obviously there's a risk going the other way. And at the moment, the big one is, look, the rates are really low, especially for, like, say, 12 months. It's the cheapest rate in the market. But what if in 12 months the rates have started going up again? And that's going to put you in a risky position, because essentially you're locking in for cheap, but you're risking that you'll fix a position, you have to refix in a year's time, and the rates may have increased, you might be paying more. So obviously you can take some risk out of that by fixing, say, a 3 or a 5 year rate. And I've got another video that I'll link here about talking about how that might be the right thing to do at the moment, as we sit here in the middle of March in 21. But ultimately, no fixed rate is without risk. If you fix short term, you risk that you're going to, say, miss the bottom of the market and the rates will have increased later. If you fix long term, you risk that the rates change and you miss them. There is no way to completely avoid that. There's obviously an option where people say, oh, why don't we fix some short and some long? It removes some risk, but it moves your ability to make a good decision based on economic values. At the moment, the economists are saying, look, the rates are going to start increasing soon. If you were to fix some short, some long, you're kind of ignoring them, and you're going to miss the benefit of getting those cheaper long-term fixed rates, because your shorter-term rate will be coming off. Then there's obviously the risk of going floating, because if you're on floating, nothing's fixed. You've got all the flexibility in the world. If the rates drop, that's great, but then there's a risk of it going up. So the key thing is that there is nothing that comes without risk in terms of fixing your interest rates, and I think that's really important to understand. But how you can manage that risk is to get some personal advice for you. From our point of view, we look at what your push-pull factors are. Do you have the ability to increase your payments in time? Do you need certainty because you might be stretching yourself a little bit to buy a bigger home, or you might just be going down to one income to have a family? There are a lot of factors there, and it's about considering those things as well as the market and ensuring you've got the right fixed loan for you, but also the right loan structure. There are a lot of other things you can do with part floatings for lump sums and revolving credits and offsets, and these all fit in, and it's really important that essentially you take the risk out of that by getting a little bit of advice. I'm here, obviously, and the rest of our team, Claire, Greg and Amber, would be more than happy to discuss options with you to give you tailored advice for your situation, which will help to remove that risk.